welcome back to the Trading Desk, June 1st edition. Guys, market continues to go up, up, up. Everything reflation. You got gold, you got interest rates. Let's talk a little bit to these issues. You got transportations, banks kind of lagging.
This is the whole purpose of the Fed's actions over the last few months is make cash trash. We want to trash cash and just make everything else go up.
Right. If Martin Zweig was ever in favor, it's now.
You bring up an interesting point, and is this rally because the dollar's been getting hammered, or is it fundamentally, because things were that bad, or where are we? I mean, I'm confused.
I think it's all the liquidity you throw at the market. It can't help but seep into stocks. There was a great article by Jeremy Grantham in his May newsletter that said, when you inject that much money into the system, it may have a hard time going down to the economic level, but it certainly has an easy time getting right into the equity markets. And that's why he's basically said...
Well, you're seeing inflation on every level.
Right.
I mean,
it's almost like mainlining it.
The yield curve is steepening. You get commodities going up. Oil is gone from back to over $60 a barrel.
Almost 70 today, 67.
Yeah,
30,
stocks going up. Everything. It's inflation. The inflation alarm is ringing right now.
So that's my concern. It's like, okay, the issues, the problems that this nation had still haven't been fixed, and now we're going back to trying to do the same game again. But the reality is, are banks truly lending? I'm still seeing lockdown on the business side, small businesses that need, for receivables are having a tough time getting cash. Businesses are still being pinched, especially the small business person. I think a lot of this big money that the government's printed has obviously gone to the banks, gone to bail out GM, $50 billion. Remember that when they were saying, well, we won't even give you 30.
Right.
And now they've already said, well, we've done 50.
So probably have to do another 50, I suspect, before all is said and done.
So, I mean, are we recreating,
Yeah, it is. It's a vicious cycle that you've seen. Alan Greenspan did it for 25 years, and every time we ran into a problem, let's inflate our way out of it. Yeah. And it's just the same thing on a much grander scale today. It's we run into these financial problems and stuff, and inflation is the answer.
But what do you
can't
guys
allow
think?
deflation.
Do you guys really think that it is going to work time and time again? I mean, is it going to work this time?
It appears to me that it worked on a lesser degree each and every time. This time we really had a significant blow up. I mean, economically speaking, we're definitely in the trough, but I think the main thing that we had this time was a collapse in the financial system. That's what made this worse. If you look at GDP growth, we definitely contracted, but no worse than we had in any other significant recessionary period. I personally happen to think that we're just giving the economy a quick shot. I personally don't believe it's sustainable, but again, when you throw that much money at the system, it's going to create bubbles in certain areas that could prolong it again for another 3 to 5 years.
There are other issues too, that the U.S. economy is so huge right now that we're not going to go back to the growth days that we had back in the mid 20th century, where you saw
I agree.
We're
now a large cap stock.
It's the law of large numbers. You're just not going to grow.
Microsoft's not going to double. Cisco's not going to double.
Absolutely.
The United States.
Well, Microsoft from 20 might get back to 40 someday.
But market cap wise, I think that's a good analogy. Is that these companies, Cisco today is replacing GM, Travelers is replacing Citigroup and the Dow 30. Okay, they're big old dinosaurs. Cisco's not a innovative, small, moving company. They're not nimble anymore. Right. They're holding on to their billions and billions of sales every year, but are they really growing?
Well, and that's something that Warren Buffett has talked about with Berkshire Hathaway for a long time. I mean, he made so much money for so many people, but he started from such a small base that it was really, I shouldn't say easy to do, but it was definitely more practical to do. When he has such a huge base on Berkshire Hathaway, now he tells everybody, if I can grow, a couple percent better than the S&P 500, I'm doing, a great job, because it's so big right now. We're not going to double in a year. We're not going to double in 3 years.
Right.
So it's.
One thing we should probably talk about when we come back for the next segment is we're talking about the economy here, but one of the things that we should talk about is, stocks as an investment relative to bonds. There was a great article that perhaps you guys read by Bob Arnott. He goes back to the early 1800s. And from a risk-reward standpoint, bonds, especially in the last 10 years, been a far better performer in terms of risk.
When you get the 30-year Treasury coming from 18% down to 3 and change, that's going to be the biggest bull market in bonds that you've seen.
But he identifies periods, with the exception of one 150-year period, It's not saying that bonds outperform, but relative to the risk you're taking, there's not that built-in 5% risk premium that you believe, that most investors believe they get. It's actually more like 1.5% to 2%.
Risk reward, guys. When we come back, we'll continue this discussion. It's always risk and reward. What can you get for your money, and where's the risk when you set it on the table?